I have the most boring topic imaginable for you today, and that is real estate. I'm bringing you the housing market forecast so that you know all about the affordability and availability of houses and kind of what the market's doing in the United States. And maybe if I'm lucky, maybe I can make it just slightly less boring for the average person.
You're boring everybody! Quit boring everyone!
Doing my research as I always do, I went to the Department of Housing and Urban Development's website and went to their housing market indicators report for the final month of 2024, and this is what I found. The first thing I found and that I found interesting is that the overall sales for pre-existing homes and new sales have both risen, which is great because I can remember as a real estate professional just a couple of years ago when just overall sales, the amount of transactions were down approximately 40% year over year, which was insane, not only for real estate professionals or anybody who works in the real estate industry, but for home buyers and home sellers. The market just sort of became stagnant, even though prices were still going up. So it's great to see that the actual number of houses that are being sold are going up. On the new single family home sales side, month over month between November and December, you can see that there was approximately a 5.9% rise in actual transactions year over year, 8.7%, which is really strong. In the pre-existing, you'll see that month over month, there was a 4.8%, so almost 5% rise in overall home sales, and year over year, 6.1%. So I'm hoping that we're starting to come out of the bottom of that gully of actual transactions, and some buyers are starting to come off the fence, and the real estate market become a little bit more active than it was late 2022 all the way through 2023. Now on the house price trend, to me, with my boots on the ground, just where I live in the middle of the Midwest, it seems like prices just cannot keep going up.
He can't keep getting away with it!
But everything that I research, all of my studies, all just point to the prices continuing to go up, which is just crazy, and they continue to do so in this data set. Now, with that being said, what we are seeing is a slight moderation in the annual appreciation of housing prices, ranging anywhere from 4.2 to 4.5%, depending on which index that you're looking at. If you look at the Federal Housing Finance Agency's seasonally adjusted purchase-only house price index, you'll see that they're reporting approximately 0.4% month-over-month increase, so just shy of 0.5%, and an increase of 4.5% year-over-year. Now, if you look at the non-seasonally adjusted CoreLogic Case-Shiller 20-City Home Price Index, you'll see that they're reporting a 0.23% month-over-month decrease, and they're reporting a 4.2% year-over-year increase. So there's a slight discrepancy there, but it's still reporting anywhere from 4.2% increase year over year to 4.5% increase year over year. So it's pretty close. It's close enough to tell us that home prices are rising about 4.5% year over year from what they were doing last year. So unfortunately, prices are still going up. Unless you're a seller, I guess. Now, inventory levels. This is something that, as a real estate professional, we are always looking at. A lot of the time we call it inventory level. A lot of the time we call it absorption rate. What we're talking about, generally speaking, is that we are looking at the rate of how long it would take based on the current supply and demand balance for all of the listings, all of the current inventory in the market to be bought. A great rule of thumb, and something that I teach people because it's really easy to remember, is that anywhere from 0 to 3 months of supply is considered to be a seller's market. Anywhere from 3 to 6 months of supply is considered to be a neutral market or a balanced market. and anything more than 6 months of supply is considered to be a buyer's market. In the last couple of years, let's say like a 5-year snapshot, the market could have been best defined as inventory deficient, meaning that there were more buyers than sellers, something that I would consider to be a seller's market. Now, if we go to the graph, you'll notice that the inventory for new home sales has increased by 2.1% month over month and 8.9% year over year. This is fantastic because this is showing that the market is starting to stabilize. It's starting to normalize and become more neutral. I always tell people that anytime that there is a serious imbalance in either direction, that's not a good thing. So, like I mentioned, we have been in a serious market imbalance in a seller's market for quite a few years. So it's nice to see some of the data sets starting to signal that we're seeing some neutralization. We're starting to see some pullback in the supply and demand. Now, if you look at the pre-existing homes, which is what most of us buy and represents a vast majority of the market, you'll see that the existing homes inventory has actually decreased by almost 3%. However, it still remains almost 18% higher than the previous year. So I'm not really alarmed by the fact that we're seeing a month-to-month decrease in supply because we're still in a really healthy place year over year. So, hey, I'll take the win. Now, the last thing is homeowner equity and borrowers underwater. This is kind of giving us an indication of, are people in trouble? Are people holding a very low equity position, or are people underwater on their houses, which is going to further kind of exacerbate the supply and demand issue if people are underwater on their house and they can't sell it to either make a profit or sell enough to just break even, then people are probably just not going to sell. So that's why I find this metric kind of interesting. Now, if we look at this chart, you'll see that homeowners on average have approximately a 1% decline in their equity position, which doesn't really surprise me because of the premiums that we were seeing in the highs of the market between 2021 and 2022. Frankly, I would have thought that this number would have been a lot more damaging than it actually is. So again, I'm pretty optimistic finding out that there's only a 1% decrease in overall equity for the average homeowner. So again, I'll take a win. Now, on the flip side of that coin, we're starting to see that some people are becoming a little bit more underwater. Again, this does not surprise me at all based on the premiums that I was seeing on the ground being sold. Some houses $50,000, $60,000 over asking price in those market highs of 2021, 2022. It really doesn't surprise me that at least right now in 2025, we're starting to see sort of an increase in buyers that owe more on their mortgages than what they could expect to sell the houses for in the current market conditions, because the market conditions are they're a lot less red-lined and red-hot. They're sort of pulled back a little bit. Again, all healthy and normal. So nothing that I'm really seeing that's showing me that there's anything to necessarily be concerned about, like a rash in foreclosures or that kind of thing. Another thing is that we haven't seen a bunch of subprime lending practices over this market pump, this bull market in the real estate market of the last 5 years. So nothing that's really indicating to me that we really have a problem with that. Doesn't surprise me that we're seeing some people starting to become underwater when they paid those premiums in the market highs. So overall, honestly, for 2024 going into 2025, based on this data set, it validates my optimism. You never know what the market is going to do, but all of the data that I'm seeing right now and that I've seen over the years is showing that the United States housing market is surprisingly resilient, and it just seems to always find a way to either recover or to stabilize and keep values going up, when honestly I thought that there was no way that values could keep going up, but that's just what the data says. So if you like this video, give it a like and give it a share, and as always, thanks for watching.